And for those of us who are just joining, we started the topic from the concept and the role of audit, which was the first topic that I took. We discussed the concept of accountability, stewardship. We looked at what is assurance engagement. And from there, we also look at fundamental principles, the safeguards, the threats to independent, safeguards to independent. So I will adjure us and encourage us for those who have just joined that you should go back to those topics, read it, familiarize yourself with them, and treat past questions. I know that there is a pack now. The management has sent a pack on the old topics, and it has been shared on the group. We can also reshare it. So that's just about what we've been doing. So today we'll be looking at the concept and role of internal audit. The concept and role of internal audit. Now, a quick one before we start. If you have questions, you can just be taking them down. You can also drop them on the chat, and you can also use the raise your hand sign to let me know. I will want us to pay attention, get your jotter nearby, and so that we are all on the same page. Today's topic is an interesting one, and in another 2 hours, we should be done. It promises to be insightful, and we'll look at it in the light of what the examiner ICAN want to test. So, vis-a-vis your knowledge of internal audit before now, we'll just focus on the areas that ICAN will be testing you from. And like I've said in some other classes, that the ICAN exam is more like uh, it is not so direct at times. You will be given case scenarios, you will be asked some questions, but your understanding of the concept is what will determine whether you actually score a good mark or not. So today we are looking at concept and role of internal audit. And when we talk about internal audit, what comes to your mind? What do you think of? We said it that audit and assurance, we are looking at external audit as a whole. We've been look all that we've been discussing before now, and all that we will discuss after today's class will center mainly on external audit. External audit, which is the statutory audit backed by law, the audit of listed companies, the audit where is carried out by external auditors, an independent person that is not in the employment of the organization but has an engagement, a contract, an agreement to come and audit them. And that audit is regulated by FRCN, is regulated by professional body ICAN, and is also regulated by the legislation of the country. So, take for instance in Nigeria, external audit is regulated by FRCN, the Company Act law, and also by the international standard. So, when the external auditor is coming to carry out a regulated work, and this regulated work, the focus is on financial statement, is expressing opinion on financial statement that this organization has complied or has applied the tools of financial framework, and they prepare the financial statement in a way that is acceptable. So that's what the external auditor has come to do. But when you talk about internal audit and internal auditors, what have they come to do? Who is an internal auditor? Who regulates their work? What is the expectation around internal audit? What do management want? Why should companies have internal audit? What are the benefits of having internal audit? And how should management decide their internal audit function? So those are the things we are looking at today. Now, if you look at your test, you can also follow me from the test. And sometimes I will be speaking not directly in line with the test, but it's all together in the test. So let's take the first thing, the definition of internal audit. So when you hear the word internal audit, now based on the text, this definition is ICANN definition. You don't have to memorize it, you just only need to understand it. Now let's look at that. Internal audit is a function or department set up within an entity to provide an appraisal or monitoring process as a service to other function or senior management within an entity. I will take it again. Internal audit is a function or department set up within an entity to provide an appraisal or monitoring process as a service to other function or senior management within an entity. Now, when you look at this definition, what does it mean? Or what is it trying to say? Now, this definition is telling us that internal audit can be an activity. That's why I say internal audit is a function. It can be an activity or a department itself. That's why the fact that you take up a company, for instance, and you don't see an internal audit department does not mean that they don't carry out internal audit activities. So you might have a company that is not listed and you don't have a single department that is called internal audit. That does not mean they don't have internal audit exercise. In some companies, it might be internal control that is doing the work of the internal audit. In some company, it might be compliance department. Some company it might even be a risk department. So the fact that you don't have internal audit in a company does not mean that they don't do internal audit there. So internal audit can be a department. It can also be an activity. That's why I say internal audit is a function as long as the activities that represent internal audit is being done, then you are talking about internal audit. Now, it could also be a department. There could be a standalone department that is saddled with the responsibility of internal audit work. And the whole essence of setting up internal audit in any company, that's why I say internal audit is a function or department within a company. The whole aim of setting up internal audit, whether as a department. Now, some other companies don't even have it as a department, they don't have it as part of work of another department. It could be outsourced. When we say outsourced, it means that the internal audit work is being done by another entity entirely. So, take for instance, we have company A. Company, they don't have internal audit as a department, they don't have it as part of the function of internal control, they don't have it as a risk and work. They just don't have anything like that. But what they've done is that they've outsourced or given that work to an external company, let's say company B, to come periodically to come and do the internal audit work for them. So that's why it's a function. In that case, it means that anytime they need to carry out internal audit work, that outsourced company will come and do the work for them. So when this definition is saying that it's a function or department, you need to understand what it means. That the fact that a company doesn't have it set up within their entity, it doesn't mean they don't do it. So now the whole essence of having internal audit is to do what? To carry out an appraisal or monitoring process as a service to the senior management or that function. Now, when you say an appraiser is more like a review of what people are doing. So when we say internal audit is to carry out an appraiser, it means that, oh, you are an HR department, you have to do recruitment, payroll, you have to do staff welfare, you have to do all of that. At the end of the day, an a department within the company or an outsourced department comes to come and assess your work. That's what it means by an appraiser. You are a finance department. You are the ones charged with payment. You are the one charged with preparing management account. You are the one charged with treasury function. You are the one charged with keeping the fixed asset. At the end of a period or a day, an external department wants to review your work. You are a marketing department. You are the one responsible for sales. You are the one responsible for branding. You are the one responsible for putting the product of the company out there. At the end of the day, an independent department within the company or outside the company that management has given the authority, they come in to say, okay, let's see what you've done for this period. Have you been doing your work right with all the assets you've been given, money budgeted for your department. How have you been using it? You are in operations, you are in production, you're supposed to do this XYZ. How far have you been doing it? So most times when internal auditors come in to carry out their work at departmental level, they are doing a form of review for management. It's different from external auditors. External auditors are not coming to do review at departmental level. They are only coming to see whether what you claim you've done vis-a-vis your financial statement and the preparation of that financial statement is in line with regulatory. Unlike the internal auditors, they want to give a feedback of your work review. So it could be for appraisal and it could also be for monitoring purpose. So what internal audit major work is to come and do a review, an assessment, a monitoring exercise for the various departments. That's why I say as service to other function and for management. So at the end of the day, management can use that report of internal auditor to determine whether there is effectiveness in the organization, whether there is a need to do a review, whether there is a need to do an adjustment, whether the asset is being used judiciously. So internal audit is very key for management. And apart from that, there could be, or we will look at that, there could be other things that management want to achieve that they don't want the process owner. When I say process owner now, take for instance, you are in marketing, you are in finance, and management wants to carry out an a special assignment in finance that the result of that assignment will determine whether finance will is form of appraisal or it will determine whether they should increase budget or whatever to finance. Now, management needs an independent arm within the company to do that. They don't want the head of finance to justify that, oh, this is why we need this budget. This is what my team have been doing. An independent arm that understand the business, that is also part of the business, to come and carry out that special assignment. So internal audits are used for this. So based on all this, these are the real essence of internal audit. Any questions so far? If you have questions, please let me know. Any questions so far? Now, if you understand what internal audit is, based on what I've explained so far, now, how do internal audit, what should internal audit, or how should it be done? Now, there's something I must say here. External audit is a regulatory audit, and that's why it's called statutory audit. When you say statutory, it means it's backed by law, the government approves it, there is a professional body regulating it, it's compulsory for listed and public entities to carry out external audit. Now, for internal audit is not a regulatory or statutory requirement. What do we mean by that? It means that companies can choose to have internal audit or not. So the fact that a company doesn't have internal audit is not outsourced, there is no department. And if the company is not listed, there is no law that says that you must have internal audit. However, having internal audit in a company is best practice. Based on the explanation I've explained that internal audit is a form of appraisal, is a monitoring. It helps management. It helps management. It helps management in decision making. And if you look at that, it helps management to monitor whether their internal control system is in place. It helps management to examine the financial and operational information. So, for instance, management wants to look at how the finance information, how are the numbers, are they speaking to each other? Is the finance management account, are they reporting at the right time? Internal audit can do that for management. Management want to access some operational information. Internal audit can carry out this assignment. They want to decide whether budget is being used efficiently. The three E's of of operations, how efficient and effective are the operations. Internal audit can carry out this exercise. Now, there are some companies that operate in regulatory industries. They are not listed companies on the public market, but they are in regulated industries, or they have regulatory oversight. Take, for instance, a food company. You have NAFDAC, you have Ministry of Health. Now, some of these companies needs to check their level of compliance with regulators. Now, to determine that, management can't be doing that every month by themselves. They need a department to be saddled with that responsibility. They need a department to take that function. So internal audit can also be a form of checking compliance for the company. And like I said, there are special investigation, maybe a case of fraud, a case of mismanagement, or just any assignment. Internal audit can do this. So the fact that internal audit is not a regulatory requirement for companies that are not listed does not mean that internal audit, then if you say it's not regulated, why do we have it? It's because of this. And based on the fact that they can do this, it means that there are some benefits. When we say benefit, advantages of having internal audit. Now, based on all I've explained, these are the benefits of having internal audit in any organization. Internal audit might not be regulated. Internal audit might not be compulsory. It might not even, it can be outsourced. But based on the fact that internal audit can be an independent arm of the management to assess other function or to appraise them, it means that they come with some advantages. And the number one advantage or benefit of internal audit is that internal audit can help in the improvement of financial controls for an entity. So an entity that has internal audit and that the internal audit is carrying out financial reviews from time to time, financial audit, it can help that management to thereby increase and improve the controls around their finances. So the one key benefit when you are in the exam, note this: improvement in financial controls or operational control within the entity. That's one key benefit. Internal audit will help any management to improve on their financial control and what operational control. So by and large, it means that the improvement in internal control around finances, internal control around operationals can be improved upon once you have internal audit. That's the first benefit. Now, the second benefit, I've said that the review of compliance can be done by internal audit, meaning that internal audit can check whether the company is complying with laws and regulation. Now, if internal audit is doing that effectively for management, it means that the internal audit can help management in the improvement of compliance. Take, for instance, year one, internal audit carry out a review of compliance of the company. Let's say a company that is in the food industry or a company in health industry, an hospital or whatever, and they prepare their report, and they find out that there are some non-compliance for the company on some regulations. Year one. Now, year two, they bring out some more. Maybe after year one, the company was fined, and the company now decide that we don't want to get this fine again, just because of the finding of the internal audit. Now the company can improve because they already know that these are the area we are lacking based on the report of the internal auditors. So they can quickly adjust, and by the time regulatory are coming, they have already mitigated the risk of being fined or non-compliant. So internal audits can help the company in improving in their compliance with key laws and regulations. And one other thing, take for instance, if a company is found to be non-compliant of some regulation, there can be legal action. There can be Even the company can their operations can be shut down. So this helps them to prepare and know where to carry out adjustment. So the number 2 point is improvement in compliance with key laws and regulations. Number one is improvement in financial controls or operational control within the entity. We are looking at the benefits of internal audit. And we've said that internal audit will help the organization to improve in financial control or operational control. Then the second thing, it will help them to improve in compliance with key laws and regulations. Now, the third thing, we've said it that internal audit also help in doing a review of the 3 E's of operations. Now, what are the 3 E's of operation? Number one, economy. Number two, efficiency. And number three, effectiveness. What do we mean by this 3 E? This 3 E is what is called value for money audit. Now, what that means is that if a company is carrying out any activities, any operations, take for instance, we have a company who is into production of whatever. Now, that company needs to purchase raw material. After purchasing the raw material, they need to utilize the raw materials, and based on the utilization, they make a product, and that product will bring in profit. Now, every company, whether it's manufacturing, whether it's service, will always have resources. We always have, yeah, they will have resources, raw materials that they will employ or use to achieve their objective. If it's a service oriented company, the human resources, now human capital, they employ people to come in, give their expertise, and based on their expertise, they deliver outstanding service to customer, and thereby they get paid and the company makes profit. Now, what 3 E's of operation is saying is that economy means that are you paying or are you paying the right money for your resources? So you are a production company, you are buying raw material. Are you buying that raw material at a cheap price, cheap and the right market price? Are you overpaying for it, or are you paying the right money for it? So every company wants to ensure that they are paying the right amount for their resources, for their raw materials. They are not overpaying. Whether the resources is human capital, whether it's raw materials, the employees you've employed, are you paying them their ideal money? Are you not? Because if you are underpaying, it means that you might not be getting the desired result. If you are buying cheap raw material, it might not be the ideal. You want to pay the right amount. You don't want to overpay, and you want to get the right amount to get the right resources. So economy is saying that getting resources at the right amount. Now, efficiency is saying that, oh, I've paid for the money, I've paid for the resources, raw material. Now, am I getting what the quantity I want from these resources? Oh, I've paid so let's say I pay a certain amount for raw material that, and I'm expecting to get 1,000 output for it. So am I getting that 1,000 or am I getting less? That's what efficiency is saying. That the resources you are utilizing, are you getting value for it? Oh, I've employed a chartered accountant, and based on that, I need to get value from this chartered accountant. Am I getting the right value? I've employed this raw material, and this raw material is supposed to give me 1,000 products. Am I getting that? Efficiency. Now, effectiveness. I'm taking my time to explain these 3 E's because going forward, you'll be seeing these 3 E's. Is a common terms in audit. You will see it under value for money audit. You will see it under a lot of topics, even in your CSME for those taking it. So by the time I finish explaining it here, I won't have to explain it again. I hope you understand. So effectiveness is saying that Are we achieving the objective we
Good evening,
want?
sir.
Good
Sir, your
evening.
screen is not moving. I don't know if it's just me.
Oh, the screen. Okay, okay,
Yeah,
okay.
it's just still on functions of internet or internal audits, the
Oh,
first
sorry,
page.
sorry, sorry, sorry. Okay, don't worry. If you look at what I'm explaining now is based on the number three, review of economy efficiency and
Okay,
effectiveness.
okay,
So
okay.
what I've done is just to explain the first part that this function is almost similar to the benefit. So I said it at the beginning of the class that if you are following me, I might not follow this test word for word, but I will cover everything in the test. So you will do me a favor here. You will be moving the text along on your phones, or but not that I won't move it, but I don't want to just be distracted with the moving. I hope you understand. Yeah.
Okay, sir. Yes, sir.
Okay. Okay. Are we together? Okay. All right. So don't worry. I will move it when I finish explaining. Mhm. So basically, I was just trying to highlight the benefit of internal audit. Why, what internal audit will do for any firm that has engaged in internal audit or that is applying internal audit, or that is making use of internal audit. And I've said it that it will help in improvement in financials and operational control. And it's stated there as a function. Now, all of these functions of internal audit, you can also use it as a benefit of internal audit. But depending on how the question comes at you, the question can ask you that what are the functions of internal audit? All these are fine. Now, based on all these functions, you can derive benefit from it. And that's what I'm explaining. That based on these functions of monitoring of internal control, examination of financial operation information, review of, based on all of this, you can get five benefits out of this. And that's why I said the first one is monitoring of fine improvement rather. If you are examining your financial and operational, if internal audit is doing that for you as a function, what it will translate to is that it will lead to improvement in the controls around financial and operation. Then the review of the three E's of it will also help the entity to improve on the three E's of operation. Oh, so they will know that, oh, should we put more money in this? Should we do that? Then the other benefit I want to talk about quickly before we move on is that external auditors, they can rely on the work of internal audit if the internal audit is efficient, if internal audit has done work that is how will I say the independence of the internal auditor can be ascertained. There are some internal audit work that external audit can rely upon. So take for instance companies that have a good internal audit system or good internal audit department, and there is a degree of independence around that internal audit. External auditor can come in, do their assessment of the internal audit, and based on their assessment, they can choose to rely on some of their work. There is a standard that speaks to how external auditors should use the work of internal auditor, when and how. So if internal audit deem it fit that this internal audit is fine, they can rely on the work of the internal audit. And what does that bring to the organization? This can reduce the external audit fee. So instead of paying so much money for the audit work, if the management find out that the internal audit is so good and their work can be relied on and the external auditor has agreed, they can negotiate to reduce the external audit fee, and that will save the company some money. So that's another benefit. Now the fifth benefit is that, like I said, internal audit is not a regulatory industry. It's not compulsory you have internal audit. But when companies have internal audit, what it's going to do for that company is that it will enhance the reputation of that company. So when you hear corporate governance, when you hear investors relations, what they are looking for, investors especially, they want to look at the company that are this company employing or adopting best practice? Are they following industry standard? So for companies that have internal audit, it improves their reputation, and that's a benefit. So based on that, you will see that internal audit is really, really important. Is really, really important. Now, in your text, because I've been just speaking based on my own understanding and review of uh, ICAN pack that I've done for a while. So, yeah, so that we're also in line. The benefits is that there is technical expertise, there is saving in cost. Then the company side, a smaller company may need the service of internal auditor, but not on permanent basis. Now, what I would do, I still have another text here that I'm using so that I want to cover as much as possible on this topic so that when you see any question from any angle, you are good to go. Now, we've talked about the benefit of internal audit. Before we go on in the test, I want us to look at the independence of the internal auditors. Now, what do we mean by independence of the internal auditor? Now, you know that as an auditor, when they say you are an auditor, external auditor, internal auditor, and I took that topic during the fundamental principle. One of the key things that every person is looking for in an auditor is independence. It is expected that auditors should be independent. Now, why do we say it's very important? Because auditors come to do appraisal, review, they come to pass their opinion. So if they are not independent, their opinion, their appraisal will not matter. And like I said at the beginning, when management wants to carry out special investigation, special assignment, it's best that they give it to internal auditor rather than give it to the process owner. The reason is that they want an independent assessment or independent opinion on on the assignment. So for internal auditors, they also need to be independent. Now, their own level of the independence might not be as high as the external auditor. And the reason why it won't be as high as the external auditor is that internal auditors are employed by the company. They are more or less employee of the company. So their independence is subjective in a way because they are paid salaried. Unlike the external auditors that come in, do their job and go. External auditors can even decide to do the work. There is no, the intimidation threat is minimal. But for internal auditors, their level of independence is very, very subjective because they're employee of the company, they are paid salaries, they also want, they can be biased over the company's goals, they can be sympathetic to management's cause. So there is this thing. How do you ensure the independence of the external auditor? I said at the beginning of this class that please have your jotter nearby and you might need to jot because some of the things I'll be saying might not be in the material, but it's all good and fine. I'm taking my time. So, quickly, methods, I want you guys to take this down. Method of ensuring the independence of the internal auditors. Method of ensuring the independence of the external auditor. I hope we're together on this call because I'll be asking questions after. I'm not the one that just talk and talk. So please take your time, get a jotter. If you have to jot on your system, please. So I want you guys to quickly take this down. Method of ensuring independence of internal auditor. Number one, reporting line. Reporting line. Number one, method of ensuring independence of internal auditor. Now, as much as you are not jotting yet, just the only thing you just need to jot at those points. Hello, is
Okay.
anybody asking? Yeah, are you asking question?
Mr. Mo, please, 1 minute. Yes, few seconds. Let me get getting in.
Okay, we'll wait for you. Get your jotter, but let
Hello.
us know once you have your. Hello, I can hear you.
Okay, thank you.
Hello,
Thank you.
so get the jotter.
Yes.
We'll wait.
Mm,
So As I will,
Okay. It
while we
said
are
method
waiting for the,
of.
do you have your jota already?
Okay, it said method of. I'm ready. Yes, I'm
Okay.
ready.
So the heading, because this part is not in the text, and I just felt it's important we have it. So this heading is
Okay.
method of ensuring independence of the internal auditor.
Method of
Methods of
ensuring.
ensuring independence of the internal auditor. Now that's all I need you to write down now first. Method of ensuring independence of. Now let me just quickly explain before you write anything. Now I said the reason why is you are not writing, no, just listen. The reason why we need to ensure the independence of the internal auditor is that they will be carrying out special assignment for management. However, their independence is subjective, is not as high as the external auditor because they are also paid employees of the company. They rely on the job for their salary, and the fact that they are employee means that they can be sympathetic to management calls. They can also be compromised on various levels. But companies should try so much as possible to ensure that there is a degree of independence with the internal auditor. And these are the things that the external auditor will look at before deciding whether to rely on the work of the internal auditor. There is a standard that speaks to using the work of internal auditor. So if external auditor, and which is also one of the benefits I've explained, that if there is a good internal auditor system in place, external auditor can actually use the work of that internal auditor. But before they can use it, these are some of the things they will look at. So method of ensuring independence of internal auditor. Number one, now you are writing. Number one, just write this: reporting lines. Do we have that? Reporting lines. Hello, I want response. Okay, I believe we
Yes,
have.
from my hand.
Yes, we're writing.
So fine. So number one, reporting line. We have that, Abby.
Yes.
Number two, number two,
Hello,
deciding. Hello.
internal auditors, right?
Yes, internal
Okay.
auditor. Method of ensuring independence of internal auditor. I hope you guys are with me. All these topics. So I believe you have the first one. Method of ensuring independence of internal auditor. I will just give out the points, then I will explain. So number two, deciding the scope of the internal audit work. Number two,
This, this.
deciding the scope of the internal audit work. Number one is reporting lines. Number two is deciding the scope of internal audit work. Then number three, rotation of internal audit staff. Rotation of internal audit staff. Then number four, appointment of the chief internal auditor. Number three is rotation of internal audit staff. Number two is deciding the scope of internal audit work. Number one is reporting lines. Number two is deciding the scope of internal audit work. Number three is rotation of internal audit staff. Number four is appointment of the chief internal auditor. Number four is appointment of chief internal auditor. Why number five, the last one, is designing internal controls. So I will take them for the last time, then I will explain. Number one is reporting lines. Number two is deciding the scope of internal audit work. Number three is rotation of internal audit staff. Number four, appointment of the chief internal auditor. And number five, designing internal control. That's all I needed to write. Now, let me explain. You are not writing now, just listen. Now, I said we are looking at the independence of the internal auditor. And because internal auditors' independence is subjective and there's a level of the independence that is not as high as the external auditor, And the reason being that internal auditor are paid employee, they rely on the job, and as such, their independence cannot be as high. And because internal audit itself is not a regulatory work, so it means that internal auditors' independence is subjective to a level. However, the management should strive to ensure that there is a degree of independence in their work or in the internal audit to the extent that the external auditor can rely on their work. And these are the things that they will look at. And we said that number one method of ensuring the independence of internal auditor is reporting line. What do we mean by that? What we mean by reporting line is that the internal audit should normally report to audit committee where it is available, or to the board of director or the highest level of management. Reporting line, the internal audit. That means the internal audit as a department, the chief internal auditor should report to audit committee and not to the head of finance or the CFO, but to audit committee
Eh,
where
eh,
available.
Excuse
You are not
me.
okay. Hello.
Am I writing now? Because my network went
No, no,
off.
no. You are not writing now. You've written all you have to. Based on
Okay.
those points I've listed, I'm just
Mm,
explaining it. That's why I want you
okay.
to listen. Because if you are
Okay.
writing, you will also not be listening very well. The ones I want you
Okay.
to write, I will let you know. Now I'm just
Okay.
explaining what, because it's one thing to write down. It's another thing to understand what you've written down. Now you've written down reporting line. And what do we mean by reporting line? What we mean by reporting line is that who the internal auditor reports to. Now, for you to ensure that there is a degree of independence in the internal audit work, for the external auditor to come in and say, I can rely on this internal audit work, they will look at who are they reporting to. If the internal audit as a department or the chief internal auditor is reporting to CFO, for instance, then there will be that independence is somehow. Because internal audit will review financial information, they can carry out financial audit. So after carrying out the financial audit, they are now submitting that report to CFO. The CFO can just say, "What's all this rubbish? You want to be exposing my department? I beg, take this report away from here," or can just throw the report away. But if after preparing the financial report of their review and is submitted to audit committee that is having oversight, or that even that is higher than the CFO, then that report can count. It means that the recommendation can be taken into action. So the reporting line of the internal audit matters. And what we are saying here is that management should create a system, or the reporting line of the internal audit should be to audit committee if it's available, or the highest level of management if audit committee is not. It should not be to the finance director. It should not be to the chief accountant. It should not be to the CFO. I hope that is clear. Then we said the second point is deciding the scope of the internal audit work. Now, the scope of the work to be carried out by the auditor should not be decided by the CFO or the finance director or the department that they want to audit. So, take for instance, the internal auditor wants to go and do operational audit for production level, and the head of operation is the one deciding how their work will go. No, the scope of the internal audit work should not be decided by the process owner. If it's going to be a finance audit, it should not be decided by the finance director. Why is that important? Because if they are the one deciding the scope of their work, they can decide that go and do the finance audit on fixed asset on a lesser area where the internal auditor will not be able to discover risk, or they won't be able to discover any contentions, so they can assign the internal audit to lesser work or areas that of less significance. So what we are saying here is that the deciding of where and what the auditors, internal auditors should do should not be left with the process owner. For instance, if it's a finance audit, it should not be the finance director, or if it's any type of audit at all, whether it's operational audit, the person responsible for that work should not be the one deciding the audit, because the risk is that they can assign them to lesser importance area for the audit. So I hope that is clear. Then we also said that to ensure the independence of the internal auditor, how is the rotation of the internal audit staff? So what we are saying here is that the internal auditor should not be allowed to be too familiar with the auditees. So when internal auditors are carrying their work and you have a group of internal auditors, there should be a form of rotations of who go. Okay, say for instance you have a team of 10, two people are the one doing finance audit this period. Next time, those two people should not be the one doing it again. There should be a form of rotation even after every time, let's say after a period or after a year, that the people who carry out finance audit this time around are not the same. Or if it's outsourced, you can have an agreement with the outsourced team, the company, that please we need different set of teams to come and do the internal audit this time around. Now that rotation will remove what we call familiarity threats, because by the time the internal audit doing the same work with the same people over time, their independence will be threatened. This is similar to what happens with the external auditor. So the rotation of the internal audit staff is very key in ensuring the independence. The fourth thing we said is appointment of the chief internal auditor. Now, the chief internal auditor or the head of the internal audit department should not be appointed by any type of senior executive that wants a yes man. Either the audit committee appoints the head of internal auditor, or the board of director, if there is no audit committee, be the ones to approve the head of internal audit appointment. And why is this important? Take for instance, if the CFO is the one appointing the head of internal audit, it means that the head of internal audit will pledge allegiance to the CFO. So the person that employ you now want to start writing contrary report against the person. No, that even if you are doing your work very well, there's something we've talked about whether in this class, independence in appearance. A third party that is informed will look at it and say, is it not this person that employ you? No, 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 you can't be independent in that situation. So the appointment of the head of internal audit should not be from the senior executive who can oversee or have a say. Rather, it should come from audit committee if it's available, or an approval from board of director. So it's very, very key in ensuring independence. Then the last thing is designing of internal control. Now, for every internal control system in place that management have put in place, whether it's financial control, whether it's operational control, internal auditors should not be involved in the designing of those internal controls. Is very important, because what we are saying is that there is a finance control in place that management has decided. That designing of that control should not be come from the internal audit department, so that what it means, there won't be self-review threat. We've talked about self-review in some other topic. When you are auditing your own work, so if internal audit is part of the people that design the finance control and they are now coming to write a report on that finance control, there is a self-review threat. So internal auditors should not be involved in the design of internal control, so that they don't come and be reviewing their own work. Is very important. So management should have separate people designing the internal control. Take for instance, that can be the work of internal control department, risk and compliance, or even the process owner or whoever, but not internal auditor. Now, these are some of the ways to ensure the independence of the internal auditors. So in exam, I just felt I should give you guys this, because I can there is no area of concentration in ICAN exam. You need to read why, and that's why you guys are attending tutorial, and I believe you're also reading on the side. So these are the ways to ensure. So quickly, before we continue, we go on with the test. I want us to look at limitations of internal audit. Now, limitations of internal audit. We've talked about the benefit, that, oh, internal audit has benefit, internal audit helps in monitoring, internal audit helps in this, but do internal audit has limitations? Now, the biggest limitation of internal audit is that, number one, internal audit is not a regulatory requirement, meaning that it's not compulsory or backed by any law. There is no requirement that every entity should have internal audit. So, as such, it means that you don't have to have a professional person that is qualified to do the work. That's why you can go to some company and you see the internal auditors. You can see somebody who study economics. You can see some of them are not even chartered. The head of the department might not even be a chartered accountant. There is no law that says it must be chartered accountant that will do internal audit work. Now that brings a limitation in itself, because when something is not a regulatory requirement, different organizations, different entities can decide on who is qualified to do that work or what experience they need for the work to be done. So that is a limitation and is a major limitation. However, some companies choose to have chartered accountant, people with qualifications to handle the internal audit department. Now, if the internal audit department is not regulated, it means that the way and manner the work will be done is left to management. So, if, for instance, somebody who studied mathematics is working in internal audit, and that's the person the management want, he can choose to do the work as he deem fit because there is no regulatory. But if the person is a chartered accountant or is somebody who is qualified, that person has to comply with the regulations of ICAN in doing that work. So the limitations around internal audit is the fact that it's not regulated. It means that different qualifications, different experience can be used by management to decide who and who take up the work of internal audit. Any questions so far? Any question? Okay, let's continue. When I get to the question part that I want to ask, I will ask you guys. Now, we're still going on. Don't worry, we are going on with the test though. But I'm just giving this. Now, quickly, I want us to also look at the risk that are considered by internal auditor. Risk. When I say risk, risk are any unforeseen circumstances that can affect the objective of the company. So all those things that can threaten the company from achieving its objective. So as an internal auditors, they look at the one of their functions or one of their work is to look at the risk that is being faced by the organization and provide recommendations to management on how to address this risk. So basically, there are three major risks that internal auditors always look at. Internal audit, based on the definition, we say is an appraisal system or a monitoring system. So internal auditor can also look at the risk and look at how this risk affects the business. So there are three major risks that internal auditor usually look at. Number one, operational risk. Now these are the risks that affect the operating activity of the entity. So when a business has an operation, maybe it's a fintech, it's a bank, it's a food, they
So
have their major operation. Hello, is anybody asking question?
you're on a subtopic now, right? Another subtopic now. So there are three major
Yes,
words.
subtopic. Yes, subtopic. Risk that are considered by internal auditors is in your text. You can just scroll to it. Because of my
Yes, yes.
network, that's why I've not been scrolling the text. I noticed that once I'm tampering
Hello?
with this. Hello,
And that's
You
your
said,
screen.
hello, can you hear me?
yeah,
Yeah.
you said you're going to explain method of ensuring
I have
independence
an
of,
internal auditor. Have I not
yeah.
explained it? Have you been listening? Please,
I
anybody.
have, oh my God.
Hello, have I
Okay, no
explained it to
problem.
anyone? No, 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 don't worry, I'll go over it. But let me just assured whether other
No.
people. Hello,
Okay,
is
but
that
I mean, since we have the class on record, I can always listen to it
okay? But
later.
please,
So
if
that I
you
will
are in
not,
Can you
class,
repeat
maybe my network then.
it?
okay. But others, I just want to get
Later.
feedback from others. Did you
Can you
get the
Okay.
widen
explanation?
I'm
Yes, sir,
hearing
we
it,
did.
sir.
You said
can you widen your
I hear
screen?
it, sir.
okay.
I get it.
You
I get it.
okay? You got it. I can also just quickly go over it again, but I don't want us to miss out on some other area. Basically, based on those 5 points I gave you guys, reporting line, um, the deciding the scope of the work of the internal auditor, rotation of staff, designing internal control, appointment of the head of internal auditor. I said that based on all this, the reporting line, who is the internal auditor reporting to? It must not be a person that ideally the internal auditor should report to a higher level of management. It could be audit committee, it could be board of director, because if they are reporting to, say, for instance, somebody like a CFO, now the CFO, they will be doing their work, so the independence might be threatened in that instance. Now the scope of work should not be decided by the person they want to audit. So it should not be the finance director deciding the area of work they should carry out. It should be somebody who they are not going to audit. So either audit committee or board of directors decide the internal audit work. Rotation of staff, that the staff used for the internal audit work should be rotated from time to time. If it's an outsourced firm, you can make an agreement that, oh, we want different level of staff. If it's in-house staff, if they do this period, a different set of staff are the one doing it. Now we also said the appointment. The head of internal audit should not be appointed by somebody who can prevail upon them. It shouldn't be a CFO. It should be audit committee level or board of director level. Then the signing of internal controls. They should not be involved in the designing of internal control, because if they do, they will be auditing their work, and that will pose a self-review threat. I hope that is clear. Now, quickly, we are looking at internal audit and risk assessment. Internal audit and risk assessment. We said that risk are anything that can derail the management from achieving their objectives. Anything that will prevent an organization from achieving its objective is a risk. And as such, internal auditors need to look at this risk and how they can help management to address this risk. And I said that there are three major areas of risk that internal auditors will look at. Number one is operational risk. Now, these are risks that are in the operating activities that can occur in operating activities. That means anything that can derail the operation, that can disrupt it. It could be error, it could be mistakes, it could be machine breakdown, it could be security problem, it could be ineffective management. Anything that can affect the operations. So these are the risks that the operation will not go as planned. So an employee has made a mistake, a machine has breakdown, there is security issues, so there can be operations, there is poor supervision, so there is production errors here and there, ineffective management, staffs are not being managed very well, so operational output is reduced. All of these are operational risk. Now auditors needs to understand this, internal auditors now. Then we say financial risk. Financial risk are changes in the financial environment that can affect the company. So there is an increase in interest rate, for instance. CBN just say, oh, we are increasing the interest rate, or there is a tax reform going on. Now, when they say, oh, in next 2 years, VAT is going to be 15% or this, that, and it might affect the company too. Probably company is planning to go into a certain collect certain credit. It could also be credit risk, the inability of the company to pay back on the credit they've obtained. Any finance risk, any changes in the finance environment. It could even be exchange rate, like in case of Nigeria, the exchange rate keeps going up for some years, and a company that trades in that, those risks can affect them achieving their objectives. So auditors, internal auditors should look at this and look at what is the effect of this risk on the company. So the financial risk can be all of that changes in the finance environment as it affect the company. Now, compliance risk. Now, we've said that one of the functions of the internal auditor is to do a review of compliance, whether the company is complying with relevant rules and regulation. Now, there is a risk that the company can be penalized, there could be fine, there could be close down of the company, there could be safety law. Take for instance, there are compliance risks that some food industry should stop the use of plastic in selling food and all of that. Now, if the regulators come and they find out that the company is not complying, they can fine the company. So internal auditors look at those risks and they will not suggest or make recommendation on how to address those risks. And that's how do internal auditor, what should they do in the management of this risk? In the management of this risk. So they wait for there are four standard way of managing risk, which is what internal auditors use to make recommendation to management. So what internal auditors will do, whether the risk is operational risk, whether the risk is finance risk or compliance risk, they will look at the risk and use any of the four ways of managing risk to make recommendation to management. So take for instance, they look at the risk. Now they can decide that management needs to accept this risk, and that's the acceptance of risk. Now, in managing risk, when you accept a risk, what it simply means is that you don't want to do anything about that risk. You just look at, okay, let the risk be there. Is either you don't do anything or you just leave the risk, or you try to reduce the risk if possible or limit the effect of the risk. So that's called risk acceptance. You look at the risks you are facing and decide, oh, there is nothing much we can do against this risk. So it's either you just manage it, you just take it as it is. That's what is called acceptance of risk. So auditors can recommend to management that, see, it's best you just accept this risk and just try and see whether you can reduce the possibility. You can't run away from it. The risk will always be there as part of your operation. So you just reduce its effect. Now, reduction of risk. There are some risks that you just don't just accept it. The first one is you accept the risk. You can decide not to do anything about the risk. Oh, maybe the risk that there will be flood on the street to your office. You are not the one in charge of preventing flood. So, and your office is sited in a locked area for the meantime, and you don't have money to go and get a new factory. You can just accept the risk and say, okay, you know what? Let's provide our employee who don't have car with a rain boot and umbrella. That's accepting risk. Now, the second one is risk reduction. This one, you don't just accept it, you plan to reduce the adverse effect of the risk. So you look for ways to reduce the effect of the risk, the consequence of that risk. Now, the first one, you choose not to do anything about it, or you just, okay, let's just see how we can reduce it a little. This one, you are intentional about reducing the risk. So you will take measures to reduce either the risk happening or reducing the effect of the risk. So maybe, for instance, there is poor management that is affecting the operation. To reduce that risk, you can say, okay, let's go and train the middle level managers, or let's bring in new experienced and competent managers. Now that will reduce the operational risk caused by poor management. Unlike the other one that you accepted, maybe flood in the street or whatever, But this one, you are intentional about reducing the risk. You take action. That's what risk reduction is saying. Then the third one is risk avoidance. Now, this one, you can choose to avoid the risk. You are not just accepting it, you are not just not doing anything about it, and you are not even planning to reduce it. You avoid it totally. What does that mean? Oh, internal auditor have carried out an assessment and they say that this is the risk that this will happen. Take for instance credit risk, that if management go ahead to get this loan facility, there is a risk that based on our overhead, our operating cost, based on our revenue for the last 3 years, and we've collected this amount of money that we'll be paying back for the next 3 years. Based on our projected sales and profit and blah blah blah, we might face the risk of paying back. We might not be able to pay back this loan as at when due. Now, risk avoidance recommendation is saying that if possible, we might decide not to take the loan again. We might just look for investors who can give money or try to bring in equity partners. So risk avoidance means that you don't involve in that situation or that transaction that will create the risk. So what internal auditor will do after assessing a situation and they see that this is the risk that you won't achieve this objective, this is the risk that can happen. Management, either than rather than go ahead and see this risk, let's quickly avoid it. So you are not exposing yourself to the risk. That's what this is saying. So that's risk avoidance. Now, the last one in some of the recommendations that internal auditor give to management or managing risk is risk transfer. Risk transfer. Now, what risk transfer is saying is that rather than the entity experiencing the risk by themselves, rather than them taking the burden and the impact of the risk on themselves, they can transfer the risk to a third party. They transfer the risk to a third party. Maybe by paying money to the third party, the risk is being transferred. An example of risk transfer is your insurance. Okay, take for instance, a company is operating in a production that uses high methane gas. They are involved in production that use inflammable gas for their production. And based on the assessment that has been carried out by the internal auditor, they find out that there is a risk of fire outbreak. So one of the ways to reduce risk of fire outbreaks is that you train your employees. You've already accepted that there will be that risk, so you want to reduce the impact. You train your employee on fire safety. You have fire extinguisher all around the operational areas. You have so many signs in case of fire run out, blah blah blah. Then another thing you can also do, you can take up insurance for the factory. So you are paying a premium to an insurance company that should fire happen, the money for building up the factory, the insurance will provide it. So you've transferred the risk of if fire happen, you won't be incurring any monetary damage, so to say, because the insurance company will cover for you. That's the risk you take for your car, for instance. When you do car insurance, that if somebody hits my car or there is a car theft, the insurance company, after proving that there's this, they will provide the car for you. So instead of bringing out fresh money from your pocket to buy the car, because you've transferred that risk to the insurance company by paying a token over time, the insurance company will give you a new car. So that's risk transfer, and that's one of the recommendations that auditors make for their management. Now, all of this, how do you answer it in an exam? So, because in an exam, the whole essence is not just to know it, is to know how to answer this. Now, there might be a question that will be paint a scenario for you, blah blah blah. This is what the company is doing. They have internal audit, and they will now ask you, what will be the recommendation of the internal auditor on the situation described above, or what should the internal auditor do to address the risk that has been identified, or in the situation above, how what is the function of the internal audit. Now, if you have any question at all that asks you what is the role of the internal audit and there is a scenario painted, number one thing you must first identify from that question is, are there risks to be considered? So you look at the question, are there risks involved? What are the control procedure for managing and limiting the risk? So the first thing, are there risks involved in these questions? What are the controls to manage or limit the risk? Then you now look at the controls. Can they be tested? Are they working? So no matter how the questions are coming at you, you can use any of the management of the risk to address it. So the questions, sometimes internal audit questions in your ICAN might not be as direct as what are the benefits of internal audit, function of internal audit. It could be that what recommendation will internal audit make in the above scenario. So you must be able to look at the question, identify the risk, and provide appropriate recommendation based on the four ways of managing risk. Any questions so far? I hope my screen is still showing. Any questions so far? Now, if there is no question, I've said it that don't mind the way I'm taking the class, because I actually had to prepare for this class. So, and while I was preparing, I didn't use your notes and the text rather. I just looked at it and I said, okay, I need to give my people enough, such that
Okay.
when they hello.
As I've been raising my hand since.
Oh, sorry, apologies. Okay, ask your question.
I just want, it's not a question. I just want to ask if you can increase the screen a little bit.
Okay.
Yeah,
Is it better now? Is it better now?
it's still the same. The lessons per se.
Uh, uh, okay. Um,
Like zooming
okay.
it.
I should zoom it.
Yeah. So the lessons can be bigger.
Okay. How about it now?
It's better now.
So
Thank you.
the other thing I want to say is that I hope all of you have this text. Do you have this text on the WhatsApp group? Have you downloaded it? Eh? Hello?
So I don't think we have the
You don't have this. So I will share it on the WhatsApp group again. I want you
okay,
guys
sir.
to I'll share it on the WhatsApp group again. So because I might not be moving it as I'm talking. So let me let me
Okay.
share it again on the group so that you can do the moving. Eh? Where is that? Okay. 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 Right. Once you see it on the group, let me know. I'm trying to share it again. Yeah. Okay. Right. Right. Okay. So I've dropped it on the group. So you can just go to the topic we are looking at. We are looking at chapter. What chapter are we? We are looking at page 24, internal audit. That's page 25 actually, internal audit. So you can just go to that so that while I'm not moving it, we are still on the same page. Is that fine? So quickly, let's continue. Now let's look at the fundamental difference between internal auditor and external auditor. Now, I've said this over and over again that your audit and assurance, as in 80 or 90% of the time, we'll be talking about the external auditor. 80 to 90% of the time, we'll be talking about external auditor. However, today we are looking at internal audit and internal auditor. Now, it's best that we look at the 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 difference or to compare external auditor and internal auditor and note that, oh, this is what internal auditor is and this is what external auditor is. So if you still have your jotter or pen, though this is just by the side, if you don't write you have the test. We want to compare external and internal audit. So let's say you have your pen just like this table has shown. You have the external auditor on, you have the first column, second column, third column. External auditor, internal auditor. Now you are doing comparison. And if you are asking an exam to do this, it will be best that you replicate it in a table format like this, if you can. But if you can't do it in a table format like this, just note, you see this first column that has um, the, when you look at the external auditor, there is and work, there is qualification to heart, there is appointment, there is duties set out. That all those key points you must be able to write for the external auditor and for the internal auditor. So if I were to tell you, or in my own way, if I want to replicate this table, I would rather have, rather than just have a serial number table and column, I will have four column. There will be serial number, there will be the first column, and that first column I will call it maybe functions or activity, whatever. Then I will now have the third column, external auditor, then the last column, internal auditor. I hope you get what I'm trying to say. Now, what we want to do is we want to look at the role and work of external auditor and internal auditor. We want to look at the qualification to act as external auditor and the qualification to act as internal auditor. We want to look at who appoints the external auditor and who appoints the internal auditor. We want to look at the duties, who set out the duties or who decide the work of the external auditor and who decide the work of the internal auditor. And we want to look at what report, who prepare, who do they report to, who do external auditor report to, and who do internal auditor report to. So that's why I'm saying that if I were to do this table again, I will have four columns: the serial number column, the function column, the external auditor column, and the internal auditor column. Now, if you've done that or you understand what I'm saying, now let's look at the duties and responsibility. So if you still have that jotter, you can write duties and responsibility. Now, under that duties and responsibility, let's look at the external auditor. What is the work of the duties and responsibility? Simply means what is the work? What do external auditor do? What is it going to do? And the internal auditor, what are they going to do? I've been explaining the duties and responsibility of internal auditor from since now, but let's look at it against the work of the external auditor. The external audit or the external auditor is to express their duty primarily. Now, these are primary duty. The primary duty and responsibility of the external auditor or the external audit is to express an opinion on the true and fairness of the financial statement. So the external auditor will do every work that it seems necessary to reach that opinion. So the work of the external auditor is to express opinion on whether or not the financial statement shows a true and fair view. Now, everything the external auditor is going to do is to help him in arriving at that opinion. That's the duty and responsibility of the external auditor. When it comes to the duty and responsibility of the internal auditor, what is the duty and responsibility of the internal auditor? The internal auditor's duty is to examine systems and control and assess risk in order to make recommendation for management for improvement. So everything the internal auditor is doing is to examine whether there is adequate control, whether the system is working as management deem it fit, and at the end of the day, whether there are any risk in the organization, and it will make recommendation for management for improvement. So the internal audit work will be dictated and determined by management. So the duties and responsibility of internal auditor is examining systems and control, assessing risk, and making recommendation for management. So that duty is more or less internal auditor is working for who? For management. Unlike external auditor who wants to express opinion on the true and fair view of financial statement. So all he's doing is to arrive at that opinion. But the internal auditor is assessing system and assessing risk for management to make recommendation to management. So his work, if management say, okay, don't assess this, do this. So by and large, internal auditors' work is as determined or are dictated by management. That's the first thing. Now, the second thing, qualification to heart. And when we say qualification to heart, the right to act as an external auditor, the right to act as internal auditor. Now, the first thing is that for external auditor, their work is set out by the statute. Is a statutory requirement. So it means that the external auditor must be suitably qualified. This external auditor must be independent of the entity. So the qualification to act by as an auditor is according to the law. And I know my other lecturer talks about the right to act as an auditor. So when he was talking about all that, he's talking about the right to act as an external auditor. The right to act as an auditor is determined by the law. So the law, because external audit is a statutory requirement. So the external auditor must be a qualified person, and that he must also be independent of the entity. That's what the law says. So for you to act as an external auditor is a statutory requirement. Now, for internal auditor, on the other hand, qualification to act as internal auditor, there is no statutory requirement to act as internal auditor. So there is no law saying that these and these people must act as internal auditor. No. So you can have somebody who study mathematics and is acting as internal auditor. It's not against the law. So management will only determine who qualify, who is competent to act as internal auditor. So it's possible that you have somebody acting as internal auditor is not a chartered accountant. It's at management's discretion. So qualification to act as internal auditor, there is no statutory requirement. Management only select competent person to act as internal auditor. So it's not a person must be an accountant, it must be chartered. No. On the other hand, if it's external auditor, it must be a qualified person. The law states it so. The person must be independent of the entities. An employee of the company cannot be an external auditor. On the other hand, employee of the company can be internal auditor. Are we together? Any questions so far? Now, we've talked about duties and responsibility, qualification to act. Now, appointment. Who appoints the external auditor? That is, who gives them the job to come and do, to come and work as? In an organization that is listed, that is regulated, that is quoted on the stock exchange, the appointment of the external auditor is done by the shareholders. Management cannot appoint external auditor. They can only recommend that this is the external auditor. But the final approval and appointment comes from the shareholders. This is also to ensure the independence of the external auditor. So the appointment of external auditor is done by shareholder, not by management. And why is this very important? It's because the external auditor will be reviewing the financial statement prepared by management. So as such, it must be independent of management. You must be able to look management and say, you guys need to, you didn't do this, you didn't do that. He's not somebody who would dance to the whims and caprice of management. So his appointment is by shareholder. I know that the other lecturer will also have talked about right under the right to act as external auditor, removal and appointment of external auditor. Now, when you comes to the appointment of the internal auditor on the other hand are appointed by management. So if you go to any company that has internal audit, whether it's outsourced, whether it's in-source, it's management that appoint them. So management usually appoint the staffs of internal audit. And that's why we say that the independence of the internal audit is subjective to a level. And that's why when I was talking about ensuring the independence, even with all those points that we've listed in ensuring their independence, the subjectivity is still there. Why? Because they are appointed and employed by management. They might be reporting to highest level of management. They might have a scope of work not determined by management, but by and large, the internal auditor are still employees of the company. Unlike the external auditor, who is an independent entity, internal auditor is not such. So note that. So we've talked about duties and responsibilities. We've talked about qualification to heart. We've just talked about appointment. Now, duties set out. What do we mean by duties set out? That's the work. And this is similar to what we have under your qualification to heart. It's still the same duties and responsibility, rather, under your duties and responsibility. You know that the duties and responsibility of the external auditor is to express opinion. So it means that the work of the external auditor is determined by law. By law, that's what we were saying there. Who decide their work? We've said that the primary duty and responsibility of external auditor is to express opinion. So who decide how he carry out his work? The statute. So the work of the external auditor is regulated. Is regulated by standard, is regulated by the profession, is regulated by the company law, is regulated by the law of the land. So there is heavy regulation around the work of the external auditor. That's why I say it's a regulatory requirement. So that work is determined by the law. Duties of the external auditor is also a subtopic under uh, that the other lecturer were taking you guys. Unlike the internal auditor, their work is determined primarily by management. Management determines how they should carry out their work, what they should do, area of focus. You know that there are some organizations that their internal auditor, they don't do financial audit, right? The management just say, since we have external auditor coming to do that, you guys just face operational audit. You guys just face compliance audit. Don't disturb yourself with financial audit since external auditors will come in. That's what the management of that company want. So internal audit work is determined by management, external audit by the statute. Then lastly, reporting. Who do external auditor reports to? When internal auditor finish their work, they prepare their audit report, they want to express their opinion, they report to the shareholders. Why? The shareholders are the one who appoint them. They are responsible to the shareholders. So external auditor reports to shareholder. Now for the internal auditor, this is a no-brainer. You should all know. If I'm the one that employ you, I'm the one that decide your work, I'm the one that say do this, don't do that. It means that what you report to me. So Internal auditors report to management. Internal auditor reports to who? Management. Now, so this table, and if there are some past questions that speaks to this, is a common question. You can just be asked, write about the fundamental difference between the external and the internal auditor, or make a comparison between the external and the internal auditor. This is what the examiner is looking for. He doesn't want you to start talking about internal auditor review, monitor, internal auditor, they carry out risk assessment. No, 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 no. Even though that's what they do, anytime they're asking for comparison or difference between external and internal auditor, this is the way and the area the external audit and the examiner wants you to answer. Wants you to talk about the duties and responsibility, more like the role and their work. He wants you to talk about the qualification to heart. He wants you to talk about the appointment. He wants you to talk about the determination of their work, the work set out, and he wants you to talk about their reporting line. Who do they report to? So that's what the examiner wants. I hope that is clear. Is that clear? Now let's go on to outsourcing internal audit. Now, at the beginning of the class, we try to define what internal audit is. And we say internal audit is a function or a department set up within an entity to carry out an appraisal or a monitoring of other function or as a service to other function or to senior management. Now, and I said that internal audit can be a department in a company, and it might also not be a department. There might not be a standalone department as internal audit. It could be part of a department, maybe internal control is carrying out the work, or a risk and compliance, or there might not even be any department doing that responsibility of internal audit, but an external department which is outsourced. So what we are saying is that there are situations where management, because management is responsible for setting up internal audit. Management is responsible for saying that we want to have an internal audit as a function, as a department. Therefore, management can make the decision that internal audit should be outsourced. So there can be instances for entity where internal audit is outsourced. That is what we want to look at. And what is outsourcing? Outsourcing means that when you give the work that can be done inside to another to do for you at a cost. There are different reasons why companies outsource different functions. There are companies that outsource the HR department. There are companies that outsource the payroll. There are companies that outsource their marketing. There are different companies outsource different things. One of the reasons why company outsource is that they want to focus on their core competence. Take for instance, a company is involved in production. That's what they do. That's what they know how to do. So rather than setting up a department of accountants to come and be doing internal audit, they can just decide that we have audit firm. Since we are not a listed company, let's just give this internal audit work to audit firm to come and do, since they will have experience in managing that, and we will focus on production. So internal audit can be outsourced. So outsourcing in itself is the transfer of management day-to-day execution to another business function or a service provider. And the reason companies do that is so that they can focus on their core competence. Sometimes companies don't have expertise or experience in that. Take for instance, a company that is into maybe advertising and they don't really know so much, and there are just a few group of company, few staff. So rather than employing experienced people to say, come and be doing our internal audit, let's give it to competent people to do. Another reason might be the cost. Oh, we are a small company. Now we need to now to go and be setting up internal audit. We'll be paying them regularly. Why can't we just, anytime we need the internal audit, let's just go and give the work to do? So it might be because of cost. Another reason company outsource might be because of size. Now, if a company is not that big, the operation is not big, they are small, and what they do is not in large numbers. So because of they want to do best practice, they now start having an extra department. Rather, let's just outsource it. So those are the reason why company outsource. Now, when you outsource internal audit, are there benefits? So what are the benefits of outsourcing internal audit? Number one benefit of outsourcing internal audit, or outsourcing rather, yeah, benefit of outsourcing internal audit is that you don't need to start doing recruitment for your own internal audit. Management is responsible for internal audit. So if you outsource internal audit, it means that the staff, those people that will be doing the internal audit work, it's not your business. You don't have to start looking and putting up recruitment. The outsource company will carry that. So, and if you don't recruit people, you don't have to train them. The outsource company will also be responsible for training. So the benefit is that you will save cost on recruitment, you save cost on training because you've already outsourced it. So you just pay the outsource company a fee. So there is no need for you to start recruiting staff and training staff. Then the other benefit, the second benefit is audit skill. Now, because most companies are not audit firm, if you are not audit firm, it means that there is a limit on the audit skills you have. So when you outsource internal audit, you are exposing yourself to getting the best audit skill ever. Take for instance, you outsource your internal audit to a company like PwC, that they should come and be the one doing your internal audit, or a KPMG, any of the big four. They are coming with expertise. They are coming with skills that you might not have in house. So even if your operation is a fintech, IT, whatever, this group of audit firm, they have that expertise. They can come in with it, IT auditors, system auditors to do the work for you. So you are exposed to audit skill. Now, this might be expensive, but at least it gives your company opportunity to taste the best. So you're exposed, that's a benefit. Now, the cost and flexibility, that's another benefit. Now, because when you outsource, what might happen is that you don't have to have the internal audit in-house. So you are not incurring costs regularly on maintaining the internal audit as a department. You only pay the cost at a period or a fixed cost. So maybe for instance, you want to be having your internal audit or for the assets to only come maybe 3 times in a year. So they will only come maybe every quarter or maybe twice in a year. It means that you only pay the cost twice a year. Unlike when you have a permanent department with staff, let's say 5 or 6 staff, and you are paying them year in, every month, there is a running cost. Unlike when you just pay for when it is needed. So there is cost and that flexibility as a benefit. Then the other one is the quantity of audit work. Now, because when you outsource and you're exposed to audit skill, you expose yourself to audit skill. What it means is that the outsource firm can do a large volume of work for you, audit work. So the outsource firm can do. Don't forget, we said there is operational audit, there is finance audit, there is compliance audit, there is monitoring of internal control. All those functions of internal audit, the outsource firm might be able to provide it for you. Unlike when you have it in house and you have to start training people to be able to do that. But when you have it as an outsource firm, they can do the monitoring of internal control, they can examine financial controls and operational informations, they can carry out the value for money audit, economy, efficiency. They can do compliance review, special. So they can actually do a lot, unlike when the work is in-house that you might have limited expertise from your staff. So that's the benefit. So the first benefit is that staff recruitment, you don't have to recruit staff for this audit skill. You are exposed to high audit skills, computer auditors, system auditors, because the audit outsource firm should be a competent firm. You are outsourcing anything you are outsourcing as a company, you should be getting value for money. You are giving it to specialized people. The reason you are outsourcing is because you want the best. So you are exposed to more of these skills, cost and flexibility. When you are sourced, you don't incur long time costs as such. You have the flexibility around the cost. Okay, I will only pay at a certain time, pay a certain fixed amount. Then the quantity of work to be done. You can also be exposed to a large volume of work at a reduced cost. Now, for everything that there is benefit, there is also what associated problem. So the fact that you've outsourced your internal audit, you are saving costs, you are exposed to more audit skill, does not mean that there can be no problem. There can be problem with outsourcing, even for any other thing you outsource. So the same way there can be problem for an internal audit that is outsourced. So an entity can have problem around the internal audit when it is outsourced. The first problem is what is called changing personnel. Now, what does this mean? When you outsource to a firm, you outsource your internal audit. They can come with a certain group of internal auditors, you do their work, and you've already signed an agreement that they will come maybe twice in a year, 3 times in a year. The next time they are coming, they can come with a different set of internal audit, internal auditors. As much as it's reducing the familiarity threat, it can pose a problem of learning curve, because as an auditor, the first thing you need to do is to understand the business you want to audit. So the set of people that came the last time, they carry away that knowledge. Now you are exposed, a new set of people will come, and that might create a problem of continuity. So changing personnel, the source firm can just be bringing different people for the work, and that can create a problem in understanding the business so quickly. It happened with external auditor when you change external auditor too. The first year for an external auditor in a client's business is always tasking, because the external auditor wants to learn the business, he wants to understand the business. So if every time you are having a different set of external auditor, it means that there will be disruption in the business, because the external auditor wants to learn. So the same problem can happen when you outsource your internal audit. They are bringing in different people. They are still asking you the same question every now and then. They are still understanding. So changing personnel is a problem with outsourcing. Then the other one is cost. The fact that you outsource doesn't mean it will be cheaper to have in-house. Some of the big four can charge ridiculous amount for consultancy services. So the fact that you feel, oh, let me outsource this thing so that we don't incur long time cost, does not mean it's going to be cheap. It can actually be costly, because some of these firms charge big money. So that you are outsourcing doesn't mean you are saving cost. Then the other thing is confidentiality. Now, the fact that you are outsourcing your internal audit function means that there is a threat, an exposure of confidentiality. You know, internal audit is not regulated. It's not a regulatory requirement. It's only best standard. It means that you have a risk of information leak. The firm that is coming to do the internal audit, they might be exposed to your information, previous information. And because internal audit is not regulated, those information, there might be confidentiality threat. There might be. So what company will do is sometimes they will need an outsource firm to sign a non-disclosure agreement, so as to mitigate the risk around this confidentiality. But the risk still exists, that there might be leakage. Take for instance, you outsource your internal audit firm, internal audit function, and the outsource firm discovers some information and they trade with it. It's a risk. So we have changing personnel, cost, confidentiality, and control. Now, the problem with control is that when you have your own staff or you have your own system of operation, you can have built-in control around it. Or you have your internal audit, you can have control, you have your finance, you can have control. But when you outsource it, it means that you are letting go of the control. You control is no more in your hands. So the control around the internal audit work might not be you might not be privy to it. You might not even have a say around it. So it means that anytime you outsource a function, you are losing control. Take for instance a firm that has outsourced its payroll. Apart from the confidentiality threat and risk of confidentiality that is there is even lack of control on how those payroll is being prepared, what software they use for the preparation, how and the composition. So there is that problem, that problem, possible problem of lack of control. Then there could be conflict of interest. Internal audits work is not regulated. So when you outsource it to a certain firm, that firm can also still take up work from your rival. So the same outsource firm can be doing work for different people. So that will test the loyalty, it will test the objectivity of the report being prepared by the outsource firm. So the easiest way to remember this problem of outsourcing, if you look at the pack, is we've tried to put all those problems starting from C. So even if you don't remember the benefit of outsourcing, once you are writing on outsourcing internal audit firm, you are supposed to, if there is a question, there can be a question like that. I think I will look at past question and send to the group. Talk about outsourcing internal audit firm. You are supposed to discuss what outsourcing is all about, how it will benefit to outsource the internal audit, and the possible problem that could be with outsourcing. Now, for this problem, we've tried to start all the points with C for easy, so that you can remember easily. Changing personnel, cost, confidentiality, control, conflict of interest. When you remember that, you should be able to build up on that. Any questions so far? Any questions so far? I'll have a question on you guys should know. So I'll before we go on, if okay, I think I've seen the past question. I'll give it as assignment so that when we come next week. So quickly, because we are about rounding up this class, as detailed as it is not so lengthy. We've talked about risk and assessment for an audit. We've talked about outsourcing. We've talked about independence of the internal auditor and ensuring it. Then, lastly, I want us to just quickly talk about this before we call it a day. Then I'll give my assignment, and I expect that you should look at it. Now, I've said it over and over that external audit is a regulatory requirement. External audit is regulated, is backed by law, while internal audit is not backed by law. So as such, the report that the internal audit prepare, there is no regulation or requirement on it, because sometimes student has that, how does the internal audit report look like, and you might also be asked what is the difference between the internal audit report and external audit report. The external audit report is backed by law, there is a standard that speaks to it, but the internal audit report is not backed by any legal requirement. So the report of the internal auditor will normally just look like any other report in the company. Your normal report that you prepare in that entity, that's the format the internal audit report will take. To have your normal introductory, executive summary, body of the report, appendix. There is no special formality for the internal audit report. It will just take the normal business reports in the entity. So in case you are asked that, so that's one of the things I want to mention. Then the other thing I want to mention is that there are different area of internal audit assignment. There could be value for money audit. Under value for money audit, these are assignment that management can give to internal auditor to do. And that was the one I was explaining before. The value for money audit looks at the three E's: the economy, the efficiency, and the effectiveness. And I said the economy means that you are getting your resources at the right money, doing it at the right money, that the money you are spending on input is justified. You are not overspending. Efficiency means that you are getting enough output. So you spend the right money for the input and you are getting the desired output. Oh, these resources cost 1,000. We are not paying 1,500 for it. These resources that cost 1,000 that we didn't pay 1,500 for it is supposed to give us 100 output. We are actually getting 100 or 120. We are not getting less. Then the last one, effectiveness. We are doing the right thing, meaning that 100 we are producing, is that what we even want to produce? We said we want to be producing meat pie. At the end of the day, it's sausage we are having. So our meat pie is sausage. That's what effectiveness is saying. Effectiveness is saying that, are we achieving the objective with the resources? Oh, I've employed a chartered accountant. I want him to help me prepare my management account, and am I paying the right money for the chartered accountant? Is the chartered accountant producing the report at the right time? Now, the report the chartered accountant is producing, is it management account? Because I employ him to produce my, is he just providing PowerPoint slide? So what we are saying with effectiveness is that is the resources meeting our objective. So that is a value for money audit. And internal auditors do this assignment for management. One other, it has its own problem. Value for money audit. There are three major problem with it. Is that measurement difficult? How do you measure this result? How do you measure that we are using the right money? How do you measure effectiveness? There are also the fact that you focus too much on cost savings. You want to save money, but sometimes it's not all about cost saving rather than achieving the objective. Then sometimes the calculation might be wrong. So that's one thing with value for money, which is a form of internal audit assignment that management can give. Another audit that management can give internal auditor is IT audit. IT audit has to looking at the general and application control on IT and ensuring that our ITs have appropriate control in place. You know, the world has gone techy. So there are a special branch of audit that focus on IT. Management can actually train their internal audit department to be carrying out IT audit. Once you have a good IT system in place, it means that the system that is producing your report can be relied on. And that's one of the things that external auditor also look at before relying on internal audit work. Any questions so far? Hello? Are you guys still there or have I been ranting?
We are here
Hello?
from my end.
Okay. Okay. Thank you for that. So I have
Question, sir.
an assignment that I want you guys to go and look at. It's a
Hello, sir.
past question. Okay, I can hear you.
Okay, good evening, sir. I have a
Good
question.
evening. Go ahead.
So my question is based on the criteria that the external auditor can look at before relying on the auditor's work that has
Okay.
been done. So what if the work done by the internal auditors did not meet that criteria for the external auditors to use the work? So does that mean that when the external auditor is coming in, they would start their own auditing stuff from the scratch without relying on
Absolutely.
information
Yes,
given to them by the internal auditor.
absolutely. Absolutely. Now, the practice in reality is that most external auditor, they don't even assess the internal auditor to use their work. That's the fact. Most external auditor, even when management say, we have a competent internal auditor in place, because the standard that speaks to, I think it's 620 now. I'm trying to remember. The standard is using the work of internal auditor. There are some things that the external auditor will check and tick off. Oh, this external auditor, there is a high level of independence. This internal auditor has competent knowledge on financial matters. They have qualified people that have been doing the work. Who did they report? All those methods of ensuring independence will be checked, and so many other factors. Now, if they check that and they find out that this internal auditor has not done a good job, they will just have to start their work from scratch. Because you know why the because is strong now. Even when they rely on the work of the internal auditor, if there is any issue in their work, they don't have the right to say, it's because we rely on the work of the internal auditor. When external auditor rely on internal audit work and use it in their work, the responsibility of the work still falls on the external auditor. So anytime external auditor is using the work of internal auditor, if there are any issue on the work, they don't have right to come and be saying that it's because it's internal auditor. And that's why in practice, in reality, most external auditors don't even bother themselves relying on the internal audit work. They will just choose to do their own work. But the standard actually says they can rely on the internal audit work. But the standard says that if there are issues, whether it's as a result of the internal audit work or whatever, the blame lies with the external auditor. So if they come and the internal auditor don't meet it, they start from scratch. Even if they meet it, if there are any issue, they bear it. So that's that. Then I must say this about internal auditor. The fact that internal audit is not regulated, or the internal audit work is management deciding the work, does not mean that there is no ethics around internal audit work. There are ethics of the internal audit work. And there is a body that has come up that is trying to put ethical guidance for internal audit work. So the body is recognized worldwide. I can also recognize them. So the body has a form of regulation for how internal audit work should be. They do documentations, they do training for internal audit. That body is called Institute of Internal Auditors, IIA. They are international bodies. They are in Nigeria. If you go on LinkedIn or you search your Google, you see them. So most internal auditors are advised. They are members of that body. They have something similar to what ICAN or IFAC is doing. So they have trainings for their members and all of that. But it's still not a regulatory body backed by law. When I say backed by law, most companies acknowledge them, but they don't they don't have that regulatory backing that they give external auditor. So they try to regulate it. They ask for support. They put training, but because internal auditor is not a regulatory requirement, some companies don't even choose to listen to them. So I hope that explains your question or
Yeah,
answers
yes,
your
sir. It does.
question. Okay, so
Thank you, sir.
before we go, I have assignment. You guys have Pathfinder, right? And if you don't have Pathfinder, you can go on ICAN and get this past question. Now, please and please don't look at the answers here too. Just try and answer these questions. Eh? Answer it to the best of your ability. I'll put it on the group too. So the first past question I want you guys to look at is November 2022, question 5. November 2022, question 5. And also to look at November 2020, question 4. The first one is November 2022, question 5. Then the second one is November 2020, question 4. So before I come next week, on during the course of the week, I want you guys to start to look at that question, try and answer it. And if you have any issues, you can just chat me. Then we look at it together. All right. Any other question before we go?
Yes, Mr. Maiwa.
Okay.
Yes, I just want to ask, what's the level of independence of the outsourced auditor?
Now that is also a question that, if you look at it, the outsourced audit firm has a higher degree of independence than the in-house auditor, which is their independence, we can say, is a bit higher than that of the internal auditor. But however, it's not as high as the external auditor. And why? The reason why it's not as high as that of the external auditor is that when you look at the comparison between external audit and internal audit, when we are looking at that table, we said that the duties of the external auditor is determined by law. That means the work to be done by external auditor is determined by law. The external audit is regulated by law. The appointment of the external auditor is done by shareholder. But when it comes to internal audit, the work of the internal auditor is set out by management. The work of the who appoint the external internal auditor is management. So whether it's outsourced or is in-house, their work is still going to be determined by management. So if management tells the outsourced internal audit firm that come and do operational audit for us, even though the outsource wants to do another work, they have to listen to management. And once somebody is determining your work, there is a level of it has eroded your independence a bit. If you remember the topic under independence, we look at independence in mind and independence in appearance. Independence of mind is saying that it's a state of being where the auditor is not under influence, is not applying, his objectivity is fine. There is no biasness in his work. He can express his opinion without any influence from anybody. It's only the external auditor that can have that level, because the work of the internal auditor is not determined by management. It's not even determined by shareholder. It's determined by the law statute. But internal audit work is determined by management. So even if you want to go this way, management can say no, don't go there. So when you talk about the independence of internal auditor, whether outsourced or in-house, is subjective. It's still, because at the end of the day, the outsourced firm wants to receive money for their work. External auditor are paid quite all right, but you can't hold external auditor anyhow. It can even be a case against the company. There is a way to determine audit fee for external auditor, but the determination of fee of internal auditor, whether paid employment or outsourced, is through negotiation with management. So their independence is still subjective. Is that clear?
Yes, sir, that's clear.
Okay. So
Thank you.
please let's check the assignment. ICAN past question November 2020 question 5. I posted it on the WhatsApp group. ICAN November 2020 question 4. So before
I
we
have,
come next week, okay, there's still question. Let's hear it.
yes, sir, for the outsourcing internal auditor. So,
Okay.
my question is, in reality, is it possible for them, for a company to outsource both the external and the internal? Uh, can it be done by one outsourcing auditor or auditing company?
That's a very good question. Now, you know, under non-audit services, that's a topic, whether in this class or professional level, there is a topic called audit related services and non-audit services. Now, internal audit work is more or less like non-audit service, in the sense that management can say we want to focus on operational audit work. We want to focus on compliance audit, but primarily the work of the external auditor is on finance audit. So everything the external auditor is doing is as it relates to the financial statement prepared by management. So the same company can be the internal auditor and the external auditor. However, if the internal audit work to be carried out will have impact on the financial statement, the law or the regulation says that that audit firm should not be the external auditor. Because if you are the external auditor and you are the one who will be part of those that will do operational audit or part of those that will write report recommendation for, internal audit work, the essence of internal audit work is to make recommendation for management. That's why we looked at risk and internal audit. That's why it's included under this topic. They will look at the risk involved in the operation, the risk in the finance, the risk in compliance, and make recommendation for management to act based on that. Now, if external auditors are coming, external auditors are not making recommendation. They are only looking at your financial statement, your control, and passing opinion. Now, the recommendation that internal audit will make is what will inform how management will have prepared their financial statement. Oh, there is this risk involved in finance, in credit. Oh, let's put this control in place. Let's ensure this. Now, external auditor will now come and look at that internal control and say it's weak, pass his opinion on financial statement. But if it's the same firm that is carrying out the external audit that make that recommendation, there is a risk of self-review. So ideally, it's advisable, which is what the law and the profession says, that the firm, if you carry out internal audit, do not carry out internal audit that will impact anything that will involve the work you will come to do as external audit. And the profession also says for listed companies, some very public listed and big public entities, it's even advised that you should not be the internal auditor at all. That all the work you will do as outsource firm for a firm should not be related to the audit. So you can go and be doing environmental consulting for the firm. But and it's called non-audit services. So that if you are going to be our auditor, you cannot do any work for us that will relate somehow to the audit. So the two firm can be, but if the internal audit work will impact the financial statement, then it's a no-no. Is that clear? That's a
Yes,
very
I
good
see.
question. That's a very good question. And I can tell you, I can ask that. So that can the outsource firm be the external auditor and internal auditor? You need to write why they can be. However, you need to state all those caveats. The work of the internal audit will not be what some of the things that will have impact on the financial statement. It will not be where they have made recommendations, because external auditors are not coming to make recommendation for how your internal control should be, how you should manage your. So most time, there are even situations that you can't be the outsource firm and be the external auditor. There are. Okay. Is there any other question?
Oh, thank you so much, sir, for the explanation.
You are welcome. Any other question from before we go?
None from my hand.
Okay. So if there is no other question, please get the Pathfinder. If you don't have it, you can go on ICAN site, download it. By now, you should have it. And like I said in some other classes, after every topic, let's look at the past question. Answer it. There is no problem if you don't know it. This is not the exam. Answer it. When we come together, we'll look at it. We'll look at the solution. We'll look at where you missed it. Then you get it better. So the past question, which is the assignment that I want you guys to try, November 2022 question 5, November 2020 question 4. If there is no other question, this is where we call it a day.